when the bubble pops, you'll find that banks have stock as collateral. They will sell those stocks in order to secure the value of their loans against them. So you're going to get a massive selling from the system, which so far has been pumping in funds into stocks. And at the same time, foreigners will try and run a mile. I mean, they've got over 20 trillion invested in US equities at the moment. And when they see the market begin to crash, they will go. And so that's a big source of selling. I think they'll probably only get out with less than 10 trillion, personally. I think they'll probably only get out with 5 trillion. They're going to lose a lot of money. And they understand this. As soon as the bubble pops, they're out. They're going to try and get out, and that's going to crash the market. So I see this happening in the not too distant future, and anyone who is invested in equities better watch out.
Hey everyone, my name is Anthony Fatsis and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Alasdair Macleod. So Alasdair is an educator for sound money, economics, geopolitics, and everything to do with gold and silver. So Alasdair, thanks so much for coming back on the podcast and hope you're having a great end to the year.
Thank you very much for having me, Anthony.
Yeah, looking forward to the conversation. Definitely a lot's happened since we spoke 6 months ago and a lot seems to have happened this year. So how would you review 2025 in your eyes?
Well, 2025 is the year when gold started front running what are inevitable developments in the dollar. I think that probably puts it in a nutshell. And it creates, if you like, the background for what we can see in 2026 and 2027. I mean, the geopolitics as well, the ups and downs of trade discussions, hardly discussions. I mean, I think that global trade has been screwed, really, by American policy, which has vacillated one way and the other. The relationship between America and China as well, I think, is a big, big topic. And it's led China, I think, to take some very serious decisions to protect its own resources. Its own resources being, I mean, we've got silver. That she stopped supplying silver automatically to the rest of the world, which was what was depressing prices of that. There is absolutely no doubt. So silver has taken off, and I think there's a growing realization that it's not just silver, but China is actually a major source, global source of processed rare earths, antimony, cobalt, all these things which are needed now. So the entire base metals sector or basket of them has actually begun to move up. So we're beginning to see inflation, which so far is not being discussed at all in monetary circles. And I think that is interesting. And I think it's irresponsible, actually, to just sit on that story, which is really what the Fed and other central banks have been doing, other G7 central banks. So quite a lot to talk about in that sense. But I think also we need to look forward to what's likely to develop in 2026 and 2027.
Yeah, as you said, a lot to unpack there, and it'll be really interesting to see where this leads to in 2026. But interesting to hear your thoughts on inflation, because you're saying you see it increasing, but obviously that's maybe not what we're seeing in at least the CPI, which we know isn't very accurate, as well as what the central banks are talking about.
Yeah, I mean, the other thing is that particularly the Fed has given up on trying to control inflation. The official story is inflation is no longer a real problem. Okay, it's 50% above the desired level, but we're not worried about it. And therefore, we end quantitative tightening, and to ensure there's ample liquidity in the system, we're going to start quantitative easing. I think actually that underneath it all, the Fed must be very, very concerned about the tech bubble, about that bursting, about the Bitcoin bubble, the consequences of that bursting. I don't know to what extent they take indications of the gold price going higher and silver price going higher, and what that might mean I mean, they've had all that, sort of sound money stuff drummed out of them, in effect. But I think they do actually see the US economy stagnating and therefore needing monetary support. Now, they're going about it completely the wrong way, but, it's irrelevant. That's the way they do it. So on that basis, I think, there is a big change, and it is going to be very, very inflationary. I think that's the key point to understand. Inflationary in the sense that, and I always prefer to look at it this way, inflationary in the sense that what will happen is that the dollar's purchasing power will decline a lot more than people think in 2026. So I think 2025 gives us the background to that.
Yeah, as you're saying, there has been this liquidity issue that the Fed have really been worried about, and that's sort of why we've brought back QE. What do you mentioned potentially the tech bubble and other drivers of that? Is there anything else where you think there's actually not enough liquidity in the system, or is this just the fact that the credit bubble is getting so large, you need so much more money printing to be able to continue to lubricate?
Well, I actually don't share the Fed's analysis on this. I think there is ample liquidity in the system. The problem is that banks are getting worried about extending credit. And so that's the real issue. And the idea of reducing interest rates and doing QT and therefore flooding the bank's balance sheets with the most liquid form of deposits possible, i.e. reserves at the Fed, is not going to be the solution. It really is not. Banks, I think, are. I mean, if you just listen to Jamie Dimon, what he's been saying, banks see this environment as being not at all friendly. And the other thing, of course, is that as far as the Treasury is concerned, they have a problem because the only debt that's really selling is very short-term debt, which actually tells us that global investors see the Fed sliding into a debt trap. I mean, what's the right rate for a 10-year bond or a 30-year bond? I mean, I know what the market's saying, but the market is, if you like, in a sort of stasis on this. But if the Treasury really tried to test it, I think you'd find that yields would start going up quite dramatically. Why? Because they reflect the risk, if you like, inherent in investing in long-term US Treasury bonds. Now, everything else takes its tune from that, including equities. What we've seen in US Treasuries is a consolidation phase from about 2022, after that very, very sharp rise, following the economy coming back post-COVID. And it looks to me, I mean, there are signs that yields are breaking out higher. I mean, the Japanese yield is going higher, and Japan is, if you like, not being very helpful because with its bond yields rising, they are now getting sort of attractive to Japanese institutions, the pension funds, insurance companies, and so on and so forth. I mean, the reason that they are the largest holders of US Treasuries is because they were getting superior returns there compared with domestic bond markets. Now that's changing. The gap is closing. Furthermore, with interest rates rising, and presumably we'll get a rise in Japanese rates in the next day or two, which is all discounted, admittedly. But with those rates rising, the carry trade is no longer so profitable. In other words, the return on the carry trade is no longer really sufficient to cover the currency risk. So putting the whole thing together, Besant at the US Treasury can see a problem down the line. So what will QE do? Well, QE basically, what will happen, I think, is that the Fed will be buying short-term T-bills in the market, which bolsters the reserves of the banks on its balance sheet, which looked another way from the bank's concern means that their deposits rise, and they will effectively take those deposits and use them to buy US Treasuries. So all this is about funding US Treasuries at the moment. I think that, the real problem which we now face is that as these bond yields at the long end begin rising again, that'll undermine the equity bubble. And we're already seeing the equity markets looking tired, let's put it that way. And when that bubble pops, I think the damage will be enormous. What you will have, and I don't know, I mean, the timing of this, it could be by the year end, it could be by, say, the end of March, that sort of period. But the timing on this, I think, means that, the bubble, when the bubble pops, you'll find that banks have stock as collateral. They will sell those stocks in order to secure the value of their loans against them. So you're going to get a massive selling from the system, which so far has been pumping in funds into stocks. And at the same time, foreigners will try and run a mile. I mean, they've got over 20 trillion invested in US equities at the moment. And when they see the market begin to crash, they will go. And so that's a big source of selling. I think they'll probably only get out with less than 10 trillion, personally. I think they'll probably only get out with 5 trillion. They're going to lose a lot of money. And they understand this. As soon as the bubble pops, they're out. They're going to try and get out, and that's going to crash the market. So I see this happening in the not too distant future, and anyone who is invested in equities better watch out. And I think the other side of that is that because it's all connected into, the financial system, this sort of crisis means that the Fed will be trying to, if you like, ensure the entire financial system doesn't go under. So they're going to be doing QE not just to finance the US Treasury, but they'll be doing it to try and support financial asset values. And the other thing that I think we're seeing, and this is a slight sideshow at the moment, is that soaring silver, if it continues, could well, if you like, raise questions about counterparty risk in derivatives markets. And this is particularly the case for London, which is an OTC market. And I think on that basis, if you've got a counterparty risk problem developing in derivative markets, then that's going to spread not just from silver, but into gold, into other commodity contracts. And because all the operators in those markets, those derivative markets, deal in everything else, whether it's interest rate swaps, whether it's currency swaps, whatever, all those things, then they're going to be questioned. I mean, we're, if you like, rather on the edge of a precipice, looking down into a chasm. That's where we are. And people who don't understand this are going to get caught, I mean, very, very seriously.
Yeah, it definitely seems like that. And I don't know if you saw today, JP Morgan have gone out and bought $350 billion of sort of treasury. So it seems like there's these regulations coming into place where banks can start holding more treasuries, and that's basically what they're going to try and do, bring in financial repression. Is that what you're seeing as well? Or they're going to, these are the last gasps of trying to keep the system going?
Well, yeah. I mean, where else does JP Morgan go is the answer. They've also, I don't know how far it's got, but they're also changing the rules, for the amount of capital that large banks hold. Now, if they invest in UST bonds, then the argument goes that that is the most superior form of asset on a bank's balance sheet, and therefore it doesn't need to have the extra capital required under Basel III for very large banks with international business. So, I mean, the US Treasury is trying to create a situation whereby it can continue to fund itself. And this is, it all amounts, I think, to desperation. Absolutely. And of course, the other thing, Anthony, if I can sort of just take that a little bit further, is you have to ask yourself why it is that these banks are not prepared to extend credit to the private sector, the real economy. They just see bad debts there. They're beginning to see the economy, the fact that the economy has been stagnating is something which I've been aware of. I'm sure they have been aware of for some time, but there are now signs with unemployment rising and all the rest of it that is, deteriorating into a recession.
Yeah, it definitely seems like it. And if that's the case for the US, what does that mean for Europe and China and other countries? Because it seems like that's they're in a lot worse position.
No, well, Europe is definitely. I mean, Europe's got different problems, and of course, Britain has too. The governorship of the EU is failing completely. I mean, it's a complete failure. In the UK, we've got a government that's got absolutely clueless. It's pursuing, classroom socialism. These guys know nothing at all, and they're just destroying the economy. We do have, very bad problems in Europe, and that's something which, basically the whole system will fall over when America falls over. I think that's the key to understanding it, because those in power in Europe, and the other thing is that, in terms of geopolitics, they've completely lost the plot. They almost need to cast Russia as evil in order to protect their own positions, which is bad. It's very, very bad. And the intelligence services are pandering to their political masters, telling them what they want to know. Yeah, the Russians are evil, etc., etc. They're doing this, they're doing that. We've got to defend ourselves, and we've got to go and defend Ukraine. Europe is a mess. Europe is basically bust. But so is America. What we have is we have a system which is based on the dollar, and when the dollar goes, the rest is going to fall like a pack of cards. Now, you mentioned China. China actually is in a very different position, because China understands that this is happening and has understood it for a long, long time, which is why they have been buying gold, which, more correctly put, which is why they have been selling dollars and also selling euros. They have a policy of reducing their exposure to G7 currencies as much as they practicably can. And not only that, but they're putting in provisions to protect themselves from the complete wipeout of the dollar. That is why the Shanghai Gold Exchange is opening vaults, or has opened vaults in Hong Kong and also Saudi Arabia. And at some stage, I have absolutely no doubt that for trade settlement purposes between BRICS members and Shanghai Cooperation members and China, whatever, and Russia, she plans for the yuan to replace the dollar in a new sort of Bretton Woods version 2. She doesn't want to get out of gold, but she's got very substantial gold reserves. Of that, I'm convinced. And she's got a plan to protect herself. Now, she won't, I think, anticipate events in the sense that announce a gold standard tomorrow. She will only do so when it is absolutely clear to the world that she needs to put it on a gold standard, the yuan onto a gold standard, in order to protect herself from a collapsing dollar. And I think that's something we're going to see maybe in the second half of 2026. And that's going to make the situation even worse for the dollar. And you've got to ask yourself, how do the Americans respond to that? Well, under the current, in fact, it doesn't matter who the president is. They are not prepared to go back onto a gold standard, to make the cuts in public spending, public sector spending, necessary to balance the budgets and produce a surplus, and to withdraw from interfering in the underlying economy. Nobody's prepared to do that. Europe, even less so. So unless there is a change in that, and that's my only single caveat, something I can't see at the moment, unless there's a change in that, I'm afraid the dollar and the euro are going to zero. and sterling for that matter. Zero. So if people who want a forecast for the gold price, you won't get a forecast from me. But what I will tell you is that forecasts are completely irrelevant, and the collapse in the currencies will drive the exchange rate between those currencies and gold. So that gold way up there somewhere in the heavens.
Yeah, so that's the major trend that you see in 2026, the collapse of the second half. Is there anything else that you're watching out for? I know that's massive.
Well, in 2026, gold will continue to front run a collapsing dollar. I think the big surprise for everybody will be the degree of inflation, which is the consequence of the collapsing value for the dollar. You then ask yourself, what does the Fed do about it? It can't do anything. It's actually trapped. That we're seeing the end of the fiat currency system. That's really what it amounts to. And I think that'll become a lot more obvious to a few of us in 2026. As far as the wider public is concerned, if the dollar survives into 2027, they will finally realize there's not prices going up, but the dollar going down. And therefore, they will start dumping the dollar. They will start dumping any liquidity they've got in return for goods, whether they need them or not. Flight into real goods, if you like, is the death throw for any fiat currency. And I think sometime in 26, maybe into 27, that's basically where we're going.
Okay, and you mentioned that you don't think the current administration can do anything to stop it. It does seem like they're aware of the issues. They just can't change what's happening. Do you agree?
I'm not sure they are aware of the issues. Bear in mind that the entire establishment, not only in America but also in the UK and Europe and also in Japan, are sort of Keynesian-based macroeconomists. They don't understand money. They don't understand credit, and that actually is number one when it comes to dealing with a crisis of loss of purchasing power of a fiat currency. And history shows that even those who do understand it, and we don't really have them in the system here at all. That there may be a few, but they're not in a position of power. History shows that even if the powers that be do understand what is happening to the purchasing power of their currency, politically, they're powerless to do anything about it. This was the lesson from Germany in 1920 to 1923, when Karl Helfferich, I think that was his name, who was the finance minister. He actually understood what was happening, but nonetheless, he presided over the collapse of the Reichsmark. He was also the person who engineered the recovery out of the destruction of the Reichsmark, which is something which not many people know. So why did he permit it to happen? Well, the answer is that he had no political alternative. And that's, even if this current lot of economically illiterate PhDs and politicians, the politicians they advise, even if they did understand it, they wouldn't be able to do anything about it. But they don't. So I can't see how the ending of this fiat currency system is going to go anywhere other than their complete destruction.
Yeah, and it sounds like that would have massive ramifications on basically every country globally. Even China wouldn't be protected from that, I'd imagine.
Well, yeah, as I said earlier, China's worked out a long time ago what the end game was. And I think they understood that America's power is entirely tied to the dollar. They haven't actually done anything to destroy the dollar. Why do that when the Americans are destroying the dollar themselves? Has been their attitude. They are very patient. They don't. The Chinese don't go in and try and sort of manipulate things their way. Not at all. In the currency sense, anyway. They'll pursue their own interests, but they won't destroy anybody else's interests. And you see this in their approach. There's the difference in the approach between America and its imperialism and China and its, if you like, oversight of BRICS and the Shanghai Cooperation Organization. China is about doing domestic business, international business deals in the interests of China. America interferes politically. First of all, it'll lend money to countries which don't need it. It will bribe the politicians. That's what overseas aid is. It's also what the British have been doing, incidentally. And as well as that, if, let us say, even after doing those two things, a minor country is non-compliant in their terms, then they arrange regime change. I tell you, the rest of the world hates America for the way it's behaved, which makes it doubly easy for China to come along and say, have I got a proposition for you? The world has moved away from us in the West. We're history. And it's all industrializing very, very rapidly, which is another point. If you look at the value of commodities priced in gold, which is relatively constant in terms of its purchasing power over long periods of time, commodities are cheaper than they've probably ever been priced in gold. Now, a lot of that is because gold is front-running the collapse of the dollar. But what it means is that in 2026, you're going to see commodity prices rising back towards where they should be compared with gold. And I reckon base metals are valued at under 20% of where they should be currently against gold, which implies that to get back to where they should be, they're going to go up 5 times measured in gold. Where does that leave it in falling value of fiat currencies? You're going to see the coppers and leads and zincs and all the rest of it, and iron ore going absolutely sky high measured in dollars, and also energy too. That's another thing. I think that the oil price it is now so low measured in gold. We know that there's an awful lot of supply and all the rest of it. Today things have sort of jumped a little bit because of America's ban on Venezuela sort of thing. But that's all noise. The fact of the matter is that when the purchasing power of a currency goes down, then the price of commodities goes up. And I think that's going to be the really big surprise in 2026. You're going to see massive commodity and raw material price rises with the knock-on effects, which will be added to the consequences of Trump's trade policies, undermining the economy, and the Fed basically going into overdrive, issuing currency, issuing bank deposits through QE, trying to save the whole system. The collapse could actually be quite rapid once it starts. But I think the point to note is that, if you actually understand what gold is telling you, it's actually telling you that next year is going to be awful for financial assets and the economic outlook. It's front running what's going to happen to the dollar.
Yeah, so important to hear. So, Alasdair, thanks so much for your time today. We've sort of covered quite a lot. And my last question is, what is one message you want people to take away from our conversation?
Well, the answer is that any wealth tied up in credit is at risk, and severe risk of going down to zero. So you need to understand what the difference is between money and credit. And in law, common law, not American jumped up legislation, but in common law around the world, money is only gold, possibly silver, but principally gold, because that is what the central banks have protected themselves with. They don't buy silver for very good reasons. It's an industrial metal, and it's being priced as an industrial metal. It's really gold. I think there are investment alternatives, as it were, but they'll all be in the commodity space. not in AI, not in whatever. I mean, there's going to be, that's the potential for a crash in equities, I think is enormous. I mean, we could see 90% of the S&P, NASDAQ, whatever, being wiped out. It wouldn't surprise me at all.
Important message. So thanks again. If anyone wanted to find out about your work, where would the best place for that be?
My Substack is MacleodFinance.com, which I know you've got on the screen. And I would, anyone who has any doubt about what we've been talking about, should educate themselves. And, I reckon you won't get a better education as to what is actually going on than by subscribing to my Substack. So it's there. If you don't take the opportunity, well, good luck to you.
Yeah, thank you. I'll put that in the description below, but thanks again for your time.
Thank you for having me.